Hi, everyone. Good morning. Give me a few minutes. Good morning. I'm going to be right back. I have to take care of one or two things and then we'll get started, okay?
Gotcha. Hi, Kelly, if you're there.
Hi, Becky.
Okay.
All right, I'm back. Everybody have a good weekend?
Yep.
Good.
Yep.
It's going to be beautiful out today. I hope you were able to get outside. All right.
There. That's the Nokia stock. So $3,400. Okay.
Okay. Sounds like yesterday we have church online for part of our service, and my minister was saying the prayers and everybody wasn't muted, and all you heard was a TV in the background, and then some guy came online in the middle of it and he started laughing, and I'm like, oh boy. We were laughing. So I'm going to ask everyone to put yourselves on mute unless you're talking. Thank you. I have to get my files out. Ooh, 10 o'clock. Let's see if we get a few more in. Start looking at the answers to our homework problems. Hopefully you got a chance over the weekend to work on them. And we'll take a look at ours. Okay, double check something and then we'll get started. Okay, just want to make sure I have the right once. Come on. So we're looking at 15.2b, 4b, and 5b. Let me share my screen. Let me see everybody. Okay, Beck, I'm going to put you on mute. Okay. Now I'm going to share the screen. Okay, so you should see the answer key right in here for 15.2b. So quite a few transactions here, but great practice on this. Paris Inc. began operations in year 1. The following is a series of transactions and events involving its long-term debt investments and available for sale securities. So I'm going to start going through the answers and explain them as we go. And if anybody has any questions, just pop on and you could ask your question. So March 10th, the company purchased Apple bonds for $30,600. So we know these are available for sale debt investments. Remember, we have trading category. That's one extreme. That's we're going to sell it quick. We have the other extreme, held to maturity, which is we're going to hold this for till the bitter end, right? And then there's that category in between, which is what we're focused on here, available for sale. So when we purchase those bonds, we will debit the asset, debt investment available for sale, $30,600, what they cost, and we'll credit cash. April 7th, they're going to purchase Ford notes, which is just like a bond. A bond will pay interest during the life of the bond at certain intervals and a principal at the end. A note is basically the same, except maybe you'll be receiving principal and interest over the life of the note. It's a loan. Both are loans. It's just the way they're being paid back to the person who bought them may be different. For our purposes, it's just like a bond. So we're going to debit debt investment available for sale.
Huh?
Could you put yourself on mute? Let's see. There we go. Okay. Debit debt investment available for sale, $56,250. Credit cash. You're just buying another debt investment. Now we're going to buy another one. This time we're purchasing Polaroid bonds for $28,200. Debit debt investment available for sale, credit cash for the cost of the bond. So each investment is a debt investment. We debit an asset account, debt investment available for sale, AFS, credit cash. Now, we know when we have an investment in this category, at the end of the year, we have to report these investments at their fair market value. We find out the fair values of the debt investment are as follows. Apple has a $33,000 fair value. That bond is at that fair value. The Ford note is at a value of $54,600, and the Polaroid bond, $29,400. So we list each of them. So we don't have to find an individual gain or loss for each bond and note. We could take the total of this category. What's the total fair value of all of those debt investments in the available for sale category? What were the original costs? So remember, this is what the balance is currently in our debt investment available for sale account. The $30,600, the $56,250, and the $28,200. So according to our investment account, has a debit balance of $115,050. What do we need to report it on the balance sheet at? 117. So we need to increase that account that increases our cost to fair value or decreases it to fair value, depending on where fair value is. Since the fair value is above the cost, we will need to debit the fair value adjustment account for the 1950. We credit unrealized gain because this is an unrealized gain. It increased in value, but it goes in the equity section of the balance sheet. Remember, when your investment is in the available for sale category, any unrealized gain or unrealized loss is reported on the balance sheet in stockholders' equity. So at the end of year one, if we did a T account for the fair value adjustment account, it will have a debit balance in it of $19.50. Are there any questions on year one before we go to year two? Okay. So let's go to year two. Just want to see something quick. Okay. I'm just making sure. Okay. Now, in year two, a couple more transactions. Now they're going to sell all of the Ford notes for $51,250. So they're going to say, okay, what's the selling price of the notes? $51,250. How much did we originally buy them for? Here they are right here. And if you don't remember, up here, remember $56,250. So they're selling them for $5,000 less than they originally bought them at. So this means they have a loss on the sale of the debt investment. So they debit cash for the amount of cash they're receiving, increase that account, decrease the debt investment available for sale account for the original amount you paid for them. Get rid of that asset. Don't own it anymore. Just sold it. And the loss is recorded as a debit to the loss on sale of debt investment. Remember, a loss account is like an expense. It increases on the debit side and it's reported on the income statement where it decreases net income, just like an expense does. Questions? Awesome. Let's go to the second. Purchased Duracell bonds for $34,650. Well, again, we purchased more bonds. So we're going to debit our debt investment available for sale, $34,650.
One moment, Professor
Cash.
Roy. I have
Yep.
a quick question.
Go ahead, Beck.
When we sell these, do we not have to get rid of the fair value adjustment thing for that thing? So wouldn't we have to debit fair adjustment value for the Ford and the unrealized loss for last year?
Not yet. You could wait till the end of the year to do that, and you're going to see that.
Okay. I
Okay.
did it when it happened.
That's fine. That's fine. You'll just, your journal entry amounts will be a little bit different. Okay. Anything else? Let's go to the 14th, June 14th. Purchased Sears notes for $25,200. So now we're buying more notes. Debit debt investment available for sale, credit cash. $25,200, the amount you purchased them at. Then on the 27th, they sold the Polaroid bonds. Now remember, the Polaroid bonds were purchased right here last year for $28,200. They're selling them for $30,600. So the sale price is $30,600, cost $28,200. So they sold them for more than they originally bought them at. So that means they have a gain on this sale of $2,400. So the journal entry you see there, debit cash, increase the cash for $30,600. Decrease the debt investment account because you sold this investment. You decrease it for its original cost. The difference, since it's a gain, is credited to gain on sale of debt investment. Remember, a gain is just like a revenue account. It increases on the credit side, it's reported on the income statement, and increases net income, just like revenue does. Now, we're at the end of the year. So at the end of last year, remember what we had here. We had Apple bond, Ford note, Polaroid bond. During the next year, we sold the Ford note and we sold the Polaroid bond. So the only thing we have left from last year's purchases, the Apple of $30,600. So there's Apple of $30,600. Then during this year, we purchased the Duracell bond, $34,650, and the Sears note, $25,200. So these are the only debt investments we have as of the end of year 2. We need to know their fair values. So at the end of year 2, the fair value of the Apple bond is $31,000, the Duracell bond, $32,400, and the Sears note, $27,600. So the total fair value of those investments is $91,000. The current balance in the investment account is $90,450. So the fair value is $550 more than the current balance in the investment account. What does this mean? It means our fair value adjustment account must have a balance of $550, enough to get it from its current balance of $90,450 up to the fair value. Well, at the end of year 2, we still have a debit balance in that account of $1950, the amount from last year. So we have to credit the fair value adjustment account so that it decreases to what we need its balance to be, $550. So when we're doing this analysis, we're trying to determine the difference between the fair value and the cost will tell us what the new balance needs to be in that fair value adjustment account. Whenever we need to increase to fair value, it has to have a debit balance. If we have to decrease to fair value, it has to have a credit balance. So since we need to have an increase of $550, we got to credit this at the end of the year, credit the fair value adjustment account for the $1,400, debit that unrealized gain equity account, $1,400. So Beck, your answer was, no matter if you did a journal entry removing the portion of the fair value adjustment at the end of the year, as you sold the bonds, at the end of the year, you would still need to have a $550 balance in it. So that's why you could wait till the end of the year to make one journal entry for the entire year. Are there any questions on that? All right, let's go to year 3. Oh, we got a whole bunch of stuff. January 28th, the company purchases Coca-Cola bonds for 40 grand. So there's our debit to the debt investment, 40 grand, credit cash, 40 grand. August 22nd, they sold all of the Apple bonds for $25,800. Wow, that was from, remember they bought these up here in year 1. Right here, there's where they bought them. They bought them for $30,600. So that's what they'll have to remove them at. And they sold them for $25,800. So they have a loss on this sale of $4,800. Sold them for $4,800 less than they originally bought them at. Debit cash then, $25,800. Credit debt investment available for sale. The cost of those, because you want to remove them, you just sold them, $30,600, and then debit loss on sale of debt investment for the $4,800. The third, They purchased Motorola notes for $84,000. Debit debt investment available for sale. Credit cash $84,000. Now they're going to have two sales. First, they're going to sell the Sears note. Let me see where they bought that at. I think last year. Yes. So they bought the Sears note last year. Remember, they debited debt investment for $25,200. So they're selling it, and they're selling it for $28,800. So they sold it for $3,600 more than they originally bought it. Debit cash $28,800 for the selling price. Credit the debt investment for the original cost, and then credit gain on sale for the gain. When they sell the Duracell bonds for 27 grand, go through the same process. I'm going to go back up here. They bought the Duracell right here. They originally paid $34,650. They are selling them for $27,000. I'm going to scroll down. So they sold them for a $76.50 loss, or they sold them for $76.50 less than they originally bought them at. Debit cash for the selling price. Credit the debt investment for the original cost. You want to remove that out of that account now. And then debit the loss on sale of debt investment for the $76.50. So now we purchased the Coca-Cola bonds and the Motorola notes, but we sold the Apple bonds. Those are gone. And the Duracell, right? Yes. Oh, and the Sears. Wow. So we sold all three of those things. What do we have left? The Coca-Cola that we just bought and the Motorola that we just bought. So at the end of year 3, we need to know what's the fair value of the Coca-Cola bonds, $48,000, and the Motorola notes, $82,000. Currently, our cost, our debit balance in our investment account is at $124,000. We need our fair value adjustment account to have an amount in it to increase the investment to $130,000, or a $6,000 debit balance is needed in our fair value adjustment account. Right now, our fair value adjustment account has a debit balance of $550. It was the balance from the end of last year. So we need to debit that account so that it increases to $6,000. And there's our journal entry. Debit the fair value adjustment account available for sale, $54.50. Credit that unrealized gain equity account, $54.50. So those are always your two accounts. It's just depending on what you need to do at the end of that year will determine what you debit and what you credit. Questions?
So you always credit the unrealized gain. What about when you're at a loss? Because we lose a lot of money on these accounts.
Right. So here's how you look at it. If you have an say you let's change this up just a little bit just to demonstrate it. Let's say instead of having let me get rid of that italicized in that. Let's say that the fair value of the investment, the total fair value of this investment at the end of year 3 was $123,000. Okay. That means this account, fair value adjustment, would actually have to have a credit balance in it. A credit balance of $1,000. Because you would need to decrease. This right here would be at 123. So what I would do is say, okay, what's my current unrealized gain account balance at? And your unrealized gain equity account is at $500. I'm sorry, $550. I would debit that first, and then I would debit unrealized loss equity for $450. So you eliminate the unrealized gain account when you actually have a loss. So that's what you would do first. Get rid of that unrealized gain balance, put the difference in the unrealized loss equity, And then your unrealized, or I'm sorry, your fair value adjustment account. I did that wrong. That should be at 1550. That should be at first. I'm gonna, okay, 1450. I did something wrong there. Oh, duh. So now the unrealized gain equity would have a zero balance. Then you would have an unrealized loss equity account. So it all depends on what the trend is. Since we've always had gain here and we didn't go into a true loss situation, we always have unrealized gain equity account we're using. But when you go and you go from always having a gain to now having a loss, get rid of the unrealized gain equity account by debiting it, debit the unrealized loss equity because now you're in a loss situation. Does that make sense?
Yes.
Okay. So hopefully that answered your question. All right. So in part 2, prepare a table that summarizes the total cost, the total fair value adjustment, and ultimately the total fair value of your portfolio of long-term available for sale debt securities at year end. And if you're not familiar with the term portfolio, that's just the word we use to describe all of the investments together. They call it an investment portfolio. So the costs of each long-term available for sale, we already determined. And I'm not trying to make you dizzy here, but go ahead back up here. And you see your total cost is $115,050 first year. The balance in your fair value adjustment account is a debit of $19.50. So on our table, $115,050 debit balance in our investment account plus the debit fair value adjustment brings us to our fair value of our securities. And that's the amount that is ultimately reported on the balance sheet. We do the same process for year 2. The total cost of all your investments were $90,450. I'm going to go ahead back up here, right here. There they are. The total balance in your fair value adjustment account, $550. So that gives us our fair value that needs to be reported on the balance sheet. And then our final, the costs of your investments are $124. The balance of the fair value adjustment account is $6,000, leading us to our fair value reported on the balance sheet, $130,000. Any questions on that? All right. Whoa, look at that. So part 3, prepare a table that summarizes realized gains and losses and the unrealized gains or losses for the portfolio of long-term available for sale debt securities at year end. Now, the realized gains and losses are reported on our income statement. The unrealized gains and losses, remember, this is an available for sale category, and you could see it right there. Okay, they're reported, I thought it was right there, but they are reported on the balance sheet in stockholders' equity. So what you're seeing here up in the top are only the gains and losses from the sales of our securities. So in year 1, there were no sales, so there was no realized gain or loss. But in year 2, there was a loss on the Ford sale and a gain on the Polaroid sale. So overall, there was a realized loss from the sale of those investments, $2,600. And then in year 3, there was a loss on the sale of the Apple, gain on the sale of Sears, and a loss on the sale of Duracell. Net those amounts all together, negative $88.50. So there was an overall loss. However, when we report our unrealized gain or loss on our balance sheet in the equity section, take that account's balance. It will be $19.50 at the end of year 1, $550 at the end of year 2, and $6,000 at the end of year 3. It actually equals whatever your fair value adjustment account is, and they always stay equal. Okay, so a great problem for that available for sale debt category. Any questions? Just want to point out that if this was the trading investment category, all the journal entries would be the same exact way, all the same. The only difference between those two categories is where unrealized gain or loss is reported at the end of the year. And unrealized gain or loss is reported on the income statement, just like it was a realized gain or loss in the trading debt investment category. But everything else is the same. All right, then I'm going to move on to problem 15 4B on page 563. Now we're dealing with stock investments with insignificant influence. All right. Oh, I went past it, didn't I? There we go. So let's take a look. February 6th, Slip Systems had no short-term investments prior to this year. It had the following transactions this year involving short-term stock investments with insignificant influence. So remember, insignificant influence is when you own less than 20% of the voting stock of the company, and they classify these as current assets. They plan on selling them within a year. Short term. So February 6th, they purchased 3,400 shares of Nokia stock, $41 per share. So debit stock investments, so an asset account, credit cash for $41 times 3,400 shares, $139,400. April 7th. They purchased 1,200 shares of Dell stock at $39 per share. Again, 1,200 shares times the purchase price of $39 a share. They will be debiting the stock investment for the cost of this, $46,800. Credit cash, $46,800. June 2nd. Purchased 2,500 shares of Merck stock at $72 a share. Once again, take the number of shares times the cost of $72 per share. Total cost is $180,000. Debit your stock investment account, $180,000. Credit cash. So 3 stock investments in this insignificant influence category are purchased. All debit to the stock investment account. Any questions? Okay, then June 30th. Now the company received a $1 per share cash dividend on the Nokia shares. So they own 3,400 shares, so they received $3,400. Now, this is a major difference between the insignificant influence and significant influence category. How we report dividends when we receive them. We always debit cash because we're receiving cash. $1 per share, and we own 3,400 shares, so $3,400. But what we credit is different under the 2 categories. When you are an insignificant influence category of ownership, you credit dividend revenue when you receive a dividend. So that's what we're doing here. Now on August 11th, they're going to sell the Nokia stock, 850 shares only of the Nokia stock, $46 a share. So the first thing we want to do is determine, do we have a gain or a loss on this sale? Take the 850 shares times $46 a share. So we're selling it for $39,100. Debit cash, $39,100. We have to decrease our stock investment account for the cost of the shares we just sold. We sold 850 shares. They originally cost $41 a share. So 850 times 41, $34,850. So we sold them for $42.50 more than we originally bought them. So we credit gain on sale of stock investment. Are we okay on that? Questions? Looks like the rest of our journal entries are receipts of dividends. So let's take a look and practice those. Received a 10-cent per share cash dividend on the Dell shares. So they own 1,200 shares of Dell times 10 cents per share. That'll be $120 in cash. Again, debit cash, $120, credit your dividend revenue. Insignificant influence, you credit dividend revenue when you receive a dividend. November 9th, they receive a $1.50 share on the remaining Nokia shares. Now remember, they had 3,400 shares, but they sold 850 of them. So just because I'm not doing this in my head, let's take a look here. 3,400 minus 850, 2,550 is the number of shares they own, times $1.50 per share. They're receiving $38.25 in cash, debit cash $38.25, credit dividend revenue. And the last transaction is on December 18th. They received a 15 cents per share cash dividend on the Dell shares. So again, take the total shares they own of Dell, 1,200. That should be, 15 cents times 15 cents per share. So now they're going to receive cash of 180, debit cash, credit dividend revenue. Any questions? Great practice on all the journal entries in this type of category. We'll be going to our last journal entry now. Because in part 2, they say, now prepare a table showing all the cost of the stock investments in this category and their fair values. And they tell us the fair value per share for each stock. So Nokia, Dell, and Merck. Let's see how we determine that. Whoops, lost my mouse. Okay, so again, the Nokia shares, we only own 2,550 at the end of the year, and they cost $41 a share. So the total cost is $104,550. Their fair value is at $40 a share. So multiply that out to get $102,000. Dell, we own 1,200. We originally paid $39 a share, $46,800. Its current value at the end of December, $41 a share. So fair value total is $49,200. And then finally, the Merck, we paid $72 for it. The 2,500, well, I should say $72 per share for the 2,500 shares, or $180,000. And then its fair value is at $59 a share at the end of the year, or a total fair value of $147,500. So remember, when you have investments, stock investments in the insignificant influence category, just like trading and available for sale debt investments, you have to report them on the balance sheet at their fair market value. So that's why we're going through this exercise. So right now, the balance in our stock investment account is $331,350. So we need a balance in our fair value adjustment account to decrease it so that it has a fair value of $298,700. There's an unrealized loss here on these investments of $32,650 in total. The fair value is significantly lower than the cost. So we're going to debit unrealized loss income. Now remember, this account, just like the trading investment category, is reported on the income statement. It reduces net income. And we credit the fair value adjustment account because it needs to have a credit balance in it of $32,650. So that when we take the investment account, which has a debit balance of $331,350, subtract this credit balance, it will report the true fair value of our investments. Questions? And that was part 3, the journal entry. So this category, we do a lot of the same type of reporting as we do under the trading debt investment. Explain the balance sheet presentation of the fair value adjustment to slip short-term investments. Well, on the balance sheet, when we report the stock investment in this category, that's what we're going to see. We're going to say, here's our stock investments, and they'll be in the current asset section, $298,700. They originally cost $331,350. We had to decrease their value using our fair value adjustment account so that we're reporting them at $298,700. Questions? Finally, how's this income statement affected? Well, there's a bunch of stuff that happened this year that affects our income statement. First of all, dividend revenue increases our net income. We had a $3,400 dividend. Then we had a $20, $38.25, and $180. So what we're doing in this section is just adding up all of the amounts that we credited to dividend revenue. That's first. What else happened? Whoops, sorry about that. We sold stock at a gain. I forget which one, but let's take a roll. Right here, the Nokia, remember we sold it? That will increase net income on our income statement. We report though on our income statement a loss of $32,650, unrealized loss. So although we had an increase in income because of revenue and dividends and selling our stock at a gain, this loss kills them. So overall, we have a net decrease of net income of $20,875. Now, how does this affect our balance sheet? Well, eventually that will decrease, that loss will decrease retained earnings because we will close those accounts out, reset them to zero, and they'll decrease retained earnings, which ultimately decreases our equity in our balance sheet. Questions? Final problem then. Now we're going to shift gears and look at investments where we have significant influence. And we know from our discussion on Friday, these are accounted for a lot differently than insignificant influence. The only thing they really have in common probably is the first one, purchasing. So we have Brinkley Company began operations in year 1 and had the following events with long-term investments. Now, when you exercise significant influence over another company, you're usually holding this investment for more than a year. So that's why they said it's a long-term investment. January 5th, Brinkley purchased 20,000 shares, 25% of Block's common stock for $200,500. We debit equity method investments. It's an asset account, and we're just using equity method to describe how we're doing the accounting for this investment, and credit cash. Now watch what happens. On August 1st, Block declared and paid a cash dividend of $1.05 per share. We don't credit dividend revenue. Remember, when you're in the equity method, you'll debit cash for the amount of cash you receive, 20,000 shares times $1.05. But you credit the equity method investments. You'll see it'll all come full circle in a second. Let's go to it. Because on December 31st, that's when we record any revenue related to block on our income statement. We don't record revenue when we receive a dividend. We record revenue related to block as they make the net income that will pay the dividend. So Block told us that they had $82,000 of net income for the year. So we will take 25% of that back at Brinkley, credit earnings from equity method investment, which is a revenue account, just like dividend revenue is, debit the equity method investment. So we recognize revenue related to this investment as the investee earns the income, not when they pay the dividend. We increase our equity method investment account as well. And then when they pay the dividend, we decrease our equity method investment, the asset account. Are there any questions on that? Okay. Year 2, Block declared and paid a cash dividend of $1.35 per share. Again, debit cash for the amount of the dividend, 20,000 shares times $1.35 each, 27 grand. Credit the equity method investment asset account for the dividend. Then, when Block reports its earnings at the end of December in year 2, debit the equity method investment account for 25%, our ownership percentage of the net income. Credit the revenue account, earnings from equity method investment. So we increase the investment as the company makes, as our investee Block here makes net income, and we decrease it as they pay dividends. Now, take a look at the last one. They sell some of it. They sell 5% of the company that they own. So Brinkley sold 5% equal to 1,000 shares of its investment in Block for $12,025. So remember, they originally owned 20,000. Now I'm going to show you how I learned how to do this, but the first part in
Excuse
here.
me, Professor Lloyd said they own 25%, not 20.
Oh, I'm sorry. Yes, thank you. Thanks for that correction. I was looking at the 20,000 shares when I said that. So they own 25%. They're going to sell 5. Okay. The first step, you could determine, okay, how much should we sell this for? 1,000 shares. We sold it for $12,025. So we know how much to debit cash. But how much do we credit the investment account? And this is different than any of the other methods, because what you have to do is first determine what's the current balance in my investment account. And remember, you have been debiting and crediting this investment account over the past 3 years. So the day you bought it, you increased it for $200,500. But then August 1st, remember, you decreased it for $21,000, and then you increased it for $20,500. So there's the decrease and the increase. Then you decreased it here for $27,000, and then you increased it here for $19,500. So as the date of the sale of this stock, the investment account has a debit balance of $192,500. So here's what you can do. You could go, okay, it cost $192,500. Oh, I can't stand this. Hold on one second. Let me see if I can. That's not what I wanted. Bear with me a second. There we go. Okay. So what I do is I go, okay. Oh man. There we go. The balance in the account is 192,500. How many shares of stock do we own? 20,000. So right now, I revise the cost per share because I had to update that account. I don't just have 20,500 in here anymore, what I originally bought it for. No, it's down to 192,500. So I take 192,500 divided by the 20,000 shares that I own, and we say, okay, how much is the cost per share on the date of the sale? And that would be 9.625. How many shares did I sell? 1,000. So 96.25 is the cost that I paid, or the value of those, the carrying value, we say, of those shares of stock I sold on the day we sell them. So that's the weird thing about this method. When you sell stock in this category, you just don't say what was the original cost. Nope, you revise the original cost by taking the new balance in the account divided by the number of shares before the sale. And that's how much the shares cost, in quotes, now. Multiply that by the number of shares you sold, and that's how much you'll decrease the equity method investment account for. Now, what your author said is, well, you know what the balance is in the equity method investment account, and you know you sold 5%. So 5% of 192,500 will also give you 96.25. So either approach, whichever one makes more sense to you. So the value, the book value or carrying value, we say right now in our books is 96.25. That's what you're considered to have paid for that. You sold it for 12,025, so you have a gain on sale of stock investment, $2,400. So just like you can sell any other investment in any other category, you could do the same here. And that's how you have to figure out the gain or loss on the sale. Questions? Well, that wraps up chapter 15. So now we have, let me see when I have that due.
Thursday, you said.
Thursday, yeah. So let's try to get through that and get your chapter 15's graded assignments done by Thursday. Wednesday, we're going to start talking about chapter 16. And Beck, do you have the due date I have for that? I'm not sure when I have the, let me see. Here, no, that's not what I wanted. Got so many things going on. Just bear with me one second. Oh. So Thursday, wrong class. Oh. I'll get there. There it is. Third time's the charm. Here we go. Thursday, we're going to start looking at chapter 16, but our overview videos will not be due until the 15th. Okay, so you don't have to worry about getting them done. We're just going to start light talking about chapter 16, and then when we get back from break, we'll hit it really hard. We'll really get into it. So give you time to read about it and to digest it. So that's all I have for today. If anybody doesn't have any other questions. All right, guys. Well, thank you very much. I'll post a link for Wednesday's meeting, and I'll see you then.
See you later, Professor Dunn.
So long. Have a great day.
Have a good day.
Thank you. You too.
Bye.
Bye-bye.
Have a good day.
You too, Kel.